Let's look at 3 signs that prove this silent abandonment is not only real, but is already having a huge impact. Evidence number 1, the widening mortgage treasury spread. This is probably the most important piece of evidence, and it's one you'll almost never hear about on TV. To get it, you need to know the relationship between 2 numbers, the interest rate on a 30-year mortgage and the yield on a 10-year U.S. Treasury bond. Lenders price mortgages by taking that risk-free treasury yield and adding a premium or a spread on top to cover their risk. Historically, that spread has hovered around a long-term average of 1.7 percentage points, though it's always fluctuated. During the QE era, when the Fed was buying up every mortgage bond in sight, that spread often shrank because the Fed's massive presence reduced the risk for private investors. But now, the exact opposite is happening. With the Fed stepping back, private buyers, banks, pension funds, global investors, have to absorb all those mortgage bonds, and they are demanding a higher price for taking on that risk. As a result, the spread between mortgage rates and treasury yields has ballooned, often hovering stubbornly above 2 or even 2.5 percentage points in recent times. Let's put that into real numbers. On a $400,000 loan, that extra spread doesn't sound like much, but it can mean an extra $200 in your monthly payment. That's $2,400 a year and a jaw-dropping $72,000 over the life of the loan. This isn't because of the Fed's main policy rate. It's a structural surcharge that's been added to the cost of buying a home because the market's biggest, most dependable buyer is walking away.